I'm just going to talk about how the funds are currently positioned and how to navigate volatile markets. We are seeing a lot of volatility at the moment, and specifically for the flexible fund. If we look at where we started the year in January, we had a 87% equity allocation in the worldwide flexible fund. 34% of that was outside of the US and 53% inside of the US. We had 5% exposure to gold bullion and cash at 8%, notably 0% in bonds. As the uncertainty started becoming more visible in February, we decided to take some risk off the table and we reduced our equity position mostly from the US, taking it down from 53% of the fund to 38%. And we put that into cash. So just looking at the forward PE of the ACWI, which is the All Country World Index, that touched about 18 times earlier this year and currently sitting at about 17 times versus its long-term average of 14.5 times. So we're currently sitting at about one standard deviation above the long-term median, which does suggest that markets are expensive. But our markets can be expensive for longer than one thinks, and some of the times justifiably so. Two examples would be if the market is experiencing strong earnings growth, and another one would be if interest rates were lower. However, when markets are this expensive, we do start looking around for other confirming factors where the market will be selling off. So we don't look at valuation in isolation. Looking at some soft data out of the US earlier this year, in Q1 of this year, we saw US consumer sentiment falling. We saw US inflation expectations increasing, and we also saw expected change in real income of consumers and the expectations of business conditions in a year's time declining. So although we'll never act on raw data alone, these were starting to giving us signals that we should be looking deeper into earnings. Prices as well as indices will follow earnings. And we've seen that since analyst expectations from the year 2022, when they were forecasting earnings for calendar year 2025, have been declining and have continued to decline. At the moment, it's not too significant. It's only seen a 5% decline in this year's earnings estimates from the last 3 years. But with more uncertainty coming from US tariffs and geopolitical events, we do expect earnings to continue coming down. So to sum it up for you, and to show you why we are very well positioned for managing funds in any environment, especially upcoming heightened geopolitical macro uncertain environments, we have the tools available to us to manage or to navigate global markets. We have an active risk management system. The point of this risk management system is to avoid large drawdowns. When we see something that is moving quickly, even if we're not 100% sure of what is driving it, we do need to stem the losses. Having said that, we do think that in down markets, we should produce alpha by being less down than what the markets are. You do get periods when there's value will outperform growth, or growth as a strategy will outperform quality as a style. By being style agnostic, we hope to take advantage of all the opportunities in the markets throughout the life cycle of markets. I think it's important to have some sort of humility when forecasting in the markets, because you do not have 100% line of sight. When you do make a mistake, you need to be able to change quickly. And when you have concentrated portfolios and you have positions 10% or 50% in size, and you are surprised to the downside, your portfolio could take a major knock. And that's one of the main reasons why we prefer to run diversified portfolios. And then probably one of the top reasons that we can navigate global markets is because we are a smaller boutique, we are a smaller team, and we are nimble. So if something happens today, The team can meet today, we can analyze today, and we can execute on that research that we've done today. And we think we're pretty sure that we have the right tools to manage money going forward.